So you want to invest in the 500 biggest companies in America. Smart move. You start looking and you find these giant S&P 500 ETFs, and they all look, well, exactly the same. But here's the thing. They're not. And one of them is probably costing you money you don't need to be spending. Today, we're going to figure out which one is the absolute best for your portfolio.
Before we even start, let's just listen to the legends. We're talking Warren Buffett, Benjamin Graham. They all say the same thing. For pretty much all of us, trying to be a stock-picking genius is a total gamble. The much smarter play, just own the whole market through a really cheap index fund. And that, right there, is exactly what an S&P 500 ETF lets you do.
And here's the why behind that whole strategy. You look back through history, and the S&P 500 has averaged a return of about 10% a year. I mean, think about that. That one number is the engine that has built an incredible amount of wealth for people. It's why this is such a powerful, simple idea. Okay, so here's our game plan. First, we'll touch on why the S&P 500 is such a big deal. Then we'll meet the three giants in the space. After that, the main event, the showdown, where we break down the key differences. Then, we'll give you our final verdict, and we'll wrap up with the one deciding factor that you absolutely need to remember. So, first up, why is everyone so obsessed with the S&P 500? Well, it's pretty simple. It's really considered the foundation, the absolute cornerstone of any modern investment portfolio. The whole value proposition here is just so clear. You're not trying to find a needle in a haystack. You're just making a big, broad bet on the American economy continuing to grow. In one click, you get instant diversification across 500 of the biggest names out there. It takes all the guesswork out of it. It's just a simple, proven way to build wealth over the long haul.
All right, let's get to it and meet the big three. If you've ever typed S&P 500 ETF into a search bar, I guarantee you've seen these names. They are, without a doubt, the heavyweights of this entire category.
First up, we have SPY. This is the OG, the granddaddy of them all. It launched way back in 1993 and was the very first ETF of the US. Its claim to fame? It's the most traded ETF on the planet, which means it has insane liquidity. It's just super, super easy to buy and sell at any moment. Next, we've got IVV. This is the iShares fund, and it's run by BlackRock. And just to put that in perspective, BlackRock is the single largest money manager in the world. So yeah, this is a very serious contender. And rounding out our top three is VOO from Vanguard. Now, Vanguard is the company that basically invented this whole low-cost investing thing for regular people, thanks to its founder, Jack Bogle. So VOO is really the poster child for their whole investor-first, keep costs low philosophy.
Okay, here we go. This is the main event. Because these three funds, they all own the exact same stocks, right? But the tiny little differences under the hood, well, they can make a huge difference in how much money you end up with. Let's break it down.
So this is the question, isn't it? They all track the S&P 500. So what is the real difference? Well, it all boils down to two things that really, really matter. How much they charge you and how they're built. Okay, look closely at this chart because this is probably the most important slide. See that column expense ratio? VOO and IVV cost just 0.03% a year. But SPY, the original, costs more than 0.09%. That means SPY is literally 3 times more expensive. It sounds like pennies, I know, but trust me, over time, those pennies turn into a whole lot of dollars. This bar chart really drives the point home. Every single year, that extra height you see on the SPY bar, that's money that is leaving your pocket and going to Wall Street. With IVV or VOO, that money stays in your account, working for you, compounding. For anyone investing for the long term, this is a massive deal. So the other big difference is kind of nerdy, but it's important. It's their internal plumbing. Think of SPY's structure, the Unit Investment Trust, or UIT, as being built on older, more rigid technology. IVV and VOO use a more modern, flexible structure, an open-end fund, and that flexibility gives them some pretty cool advantages. Okay, so here's how that nerdy structural stuff actually affects you. Because SPY's structure is so rigid, it can't reinvest the dividends from its stocks right away. That creates a little bit of a performance drag. It also can't do this thing called securities lending, which is basically renting out its stocks to make a little extra cash. While IVV and VOO can do both of those things, which makes them just a little more efficient. Now, SPY's one big pro, All that trading volume we talked about, it's still the king for big-time, high-frequency traders. So we've looked at the costs, we've looked at the structure, now it's time to make a decision. Let's get to the verdict. Which one of these ETFs is actually the best choice? Well, the answer really depends on what kind of investor you are.
Okay, it really comes down to this. If you are a professional trader, somebody who's moving millions of dollars in and out of the market every single day, then yeah, SPY is your best friend. That massive liquidity is exactly what you need. But for literally almost everyone else, for all of us who are just long-term buy and hold investors, VOO and IVV are the hands-down winners. It's not even close.
So let me be crystal clear here. For the average person who is building a retirement account or just investing for the future, VOO or IVV are without question the superior choices. That tiny little difference in fees, it might seem like nothing, but over 20 or 30 years, it can add up to tens of thousands of dollars in extra money for you. It is the definition of a free lunch in the investing world. But wait, the story doesn't quite end there. The fee war is intense. So State Street, the company behind the expensive SPY, launched a newer, much cheaper fund to compete. It's called SPYM, and at just 0.02%, it is now technically the cheapest S&P 500 ETF on the market, beating VOO and IVV by just a hair. So now that you have all these options, VOO, IVV, even the super cheap SPY, what's the one thing, the single most important factor that should really guide your decision? It's this. This is the whole ballgame. Market returns are never guaranteed. They go up, they go down, you can't control it. But you have 100% absolute control over the fees you pay. Cost is constant, and choosing the lowest cost fund is the single most reliable thing you can do to make sure more of the market's return ends up in your pocket, not someone else's. And that kind of leads us to one last thing to think about. Okay, you've picked your fund, you're ready to go. But here's the catch. Because the S&P 500 is weighted by size, the top 10 biggest companies now make up almost 40% of the entire index. So the big question you have to ask yourself is, are you really as diversified as you think you are? That's a topic for another time. Thanks for joining me.